Well, thank you, everyone. Hopefully everyone enjoyed their lunch. I'm Christy Harkins. I'm the Chief Marketing Officer here at OTC Markets Group. And I'm thrilled today to help host this panel discussion. So before we kick off, I'm just going to let each of our panelists give you a quick once-over on themselves, their role, and then from there we'll jump straight into questions. Why don't you start, Jason?
First.
Go ahead.
Well, I kind of said my piece this morning for those of you that are here, or for those of you that weren't. I'm Jason Paltrowitz, Director and Executive Vice President of our Corporate Services business. I've been part of the company now as a board member and running our listings business for probably close to 15 years. Have watched us grow up from a little ATS to what is now a fully regulated super ATS, and as I said this morning, the largest stock market for non-US equities here in the States. So helping issuers, early stage growth companies like the ones you have heard from today, all the way up to the likes of Roche, Adidas, Heineken, Air Canada, Marks and Spencer, to be able to provide US investors the opportunity to buy global equities from around the world in the most efficient, regulatorily cost-effective manner. I've had the privilege of working with all three of my co-panelists in doing the same. And again, thank you all for coming and taking the time.
Thank you, Jason. I'm Richard Carlton, the CEO and also a director of the Canadian Securities Exchange. I've been in the role since 2011. In some respects, it seems like ages and ages and ages. Other, it's gone by in a heartbeat. We are, Sarah Louise, I liked your line, Challenger Exchange. We are ourselves a startup, began in 2003 and recognized as an exchange in 2004. We have, I think as of today, more than 750 listed companies on the exchange, and a number of folks here representing the community. And we have been, over the last few years, among the fastest growing equity markets in the world in terms of new companies coming on. Have worked very well over the years with our friends and colleagues from the OTC markets to bring, in many respects, Canadian and international companies access to the US, the greatest pool of equity capital in the world. And more recently, we've been working with our colleagues and friends from Aquis to figure out, again, how do we provide a better path to UK and European capital for companies that are listed on the CSE.
My name is Brian Stockbridge. So I run a company called First Sentinel. So we focus on raising capital for growth companies, floating them on the UK stock markets, and we're also a sponsor for OTC as well. So having that extra cross trade, I think, is quite key. In my background, I've been a regulator. I was at the takeover panel in the UK. I've been a nominated advisor floating companies on AIM. I floated companies on the London Stock Exchange and also on Aquis. And I've been on the other side of the fence as well as a director of a company on all three of those markets. So I've sort of seen transactions from multiple angles. And we're very, very strong supporters of the Aquis market for growth companies in the UK. And I think, adding the extra dimension where you can use OTC as well to access a wider investor pool is key. So we're pretty excited to be here today.
Sarah Louise. My name is Sarah Louise. I head up the business development team at Aquis Stock Exchange. For those of you who haven't heard of Aquis Stock Exchange, we are part of the Aquis Group. And our mission is to make markets better for the modern economy. We have a trading platform that was created in around 2013, where we trade around 6,000 stocks across 16 markets in Europe. We do that through a fairly innovative subscription model, where big, European banks are our customers, and we trade around just over 2 billion a day. Then we have a technology division where we create and license infrastructure and cutting-edge technology, which we help emerging markets across the globe with. And the final piece of the jigsaw puzzle was Aquis Stock Exchange, where we took over the license just over 4 years ago. So we are a relative baby in terms of global exchanges, but we have been able to attract more new listings than our better known rival over the last couple of years. And we've done that through lots of measures that I can go through earlier, but making markets more accessible and efficient. In terms of myself, I've been involved in capital markets for about the last 20 years. I've always had a passion for helping companies develop and grow, enabling them to access the capital they need to scale, and being able to do that and create a new exchange has been a real career highlight. I've predominantly been working in London, but have been based in Hong Kong as well for around 7 years. I'm a mum of 3, and a passion of mine is educating and informing female founders so we can see more women leading public companies. Thank you.
Excellent. Well, thank you. I think we've already touched on quite a few of the themes that we're going to kind of delve a little deeper into throughout the course of the discussion. I think part of what today's program highlights is really the importance of venture markets, the importance of cross-trading here in the US. So I just wanted we'll start with Richard to just dive a little bit deeper into the Canadian market, and kind of really how you're helping venture companies to experience that growth and success.
So the Canadian market is almost unique in the world in that we bring a lot of companies that are pre-revenue into the public capital markets. And I think the fairly simple and straightforward reason for that is our grounding in the natural resources extraction industry. So whether it's oil, gas, and mining. And so by definition, if you're exploring for base metals, for precious metals, or wildcatting for oil and natural gas, you don't have any revenue stream. You hope to have one. And of course, that also teaches the investor base about risk-adjusted capital. So that, again, where there's no guarantee, in fact, there may be a small chance of a significant return, the returns, in fact, are adjusted accordingly. So, again, there are fabulous returns that could be made with successful investment in the venture space. But it is, of course, risky, and a significant percentage of the companies, in fact, don't make it. It's the same on the private equity side. Our private equity colleagues love to refer to the retail market as dumb money. In fact, they made a movie about it. I think they called it.
It's called Dumb Money.
It was called Dumb Money. The reality is their track record is actually no different. The failure rate, or worse, and yeah, in fact, in the most recent That's Right numbers, it's actually worse. So again, I think I put my faith in the wisdom of crowds. As Jason mentioned this morning, we believe passionately, along I think with our colleagues on the panel today, it's not the role of the exchange to try to reduce risk through a merit-based regulation of the companies, to second-guess company management or to second-guess the shareholders. Our role is to provide as much information as possible for the markets to price risk. So yes, we have to ensure that the company meets certain standards, that the folks that are involved with the company don't have a track record of malfeasance in the public markets or otherwise. So we have to do a lot of work in that direction. But in terms of the actual business risks, those are something that the shareholders and subsequent investors in the company are the ones that are, in fact, actively involved in pricing. And I think that is an extremely effective way of reducing cost and, in particular, time to market. So, again, what we're hoping to provide, and yes, it's in contrast to services on other exchanges they might be able to access in the Canadian market, is a faster, more predictable, more objective path to the markets. And we all know time is money, time is risk. And if we can reduce that, as I say, we can provide a better, faster path to accessing public capital for these companies.
And Sarah Louise, as you hear Richard talk and you kind of think about the UK market, obviously very different, but how are you thinking about your role overall kind of in helping venture stage companies? What does the UK kind of specifically look like from your point of view?
So I guess the benefit of being new is that you can design it yourself. We're a small company ourselves. We're a growth company. We're a fintech company. We went through the process of going public on another market in 2018. It was long, painful, expensive. What we thought was a welcome ceremony ended up being a farewell party because we never spoke to the exchange again. And we kind of thought there must be a better way. So yeah, when the opportunity to buy the exchange came up in 2020, we really thought, how do we make this work for companies, growth companies that are looking to use the public markets to scale today, and not try and squeeze them into an old structure. So making the admission process much more efficient, templating the admission documents, limiting risk disclosures, those types of things, trying to make it as straightforward and attainable as possible. We created 2 segments of the growth market. So we have Access for earlier stage businesses and Apex for more established businesses, larger businesses. So you can come to Access as a very small company, learn the ropes, and hopefully your trajectory is to then move on to Apex, where we've added in additional regulatory requirements that we know institutional investors are more comfortable with. And yeah, so it's we also really value the exchange partnership. We see ourselves as partners with our companies. We get to know them. We feel like if we understand their objectives and we're talking to them regularly as an exchange, not just through the advisor, but we work closely with the advisors as well, that we feel that we can support them better in that way. And so, with better rules or more appropriate rules, with the direct exchange relationship, with the admission process being more efficient and saving you time, and therefore in some instances cost. And we've also created a kind of an ecosystem of partners and advisors, so you have choice. You don't have to go to only the large advisors that have the big offices and charge much more. You can go to smaller advisors that are much more relevant to you as a company and that stage of your development. So all those things combined just make it more, a better experience for companies, and that's our mission.
We're hearing common themes throughout this. Jason, I'm going to turn it to you, just because obviously from OTC Markets' vantage point, we have experience kind of partnering and working with companies, having a venture market ourselves. So maybe you can just kind of add a bit to the discussion as we think about themes of efficiency, increased standards, but also eliminating some of those regulatory complexities, and kind of how that all bridges that gap to U.S. investors.
Yeah, well, we kind of sit in the middle of all of this. We are also a U.S. public company listed on our OTCQX market. And like I said earlier, I was on the board when we were private and watched us go through this evolution of becoming a public company. And what you learn very quickly in the capital markets is there's an entire ecosystem of people out there that are telling you there's one path. And that path is, NASDAQ or New York, and that's where you have to go. And as a small private company at the time that really just wanted to go public to give our investors the ability to price their investment, right? All of the private investors that were part of our journey, we were sick of getting that phone call every time we had a board meeting to say, what's my investment worth? We said, well, we should go public so they can go see what their investment is worth in the public markets. And realizing that natural path was not the right path for us. We didn't need to raise a bunch of capital. We didn't need to sign on for all the cost and complexity of being an SEC reporting, Sarbanes-Oxley subjected company, and doing all those things and going through the process of a merit review, right? So the rules and regulations on the U.S. exchanges are really done to mitigate risk around the S&P 500 index type companies. And if you're not one of those, you're paying for a lot of stuff that doesn't make any sense. At the same time, while Sarbanes-Oxley was happening, we were working through the reality in the international space of all the companies that no longer wanted to be listed here because of Sarbanes-Oxley and the costs and complexity were going with that. And we saw companies, the Roche, Adidas, Heinekens of the world, saying there has to be a better way. We need to be able to access U.S. investors, access U.S. capital. But if I'm meeting the standards of the UK or Germany or Switzerland or any other market in the world, Why should I have to do that all over again to meet the US? Swiss disclosure is probably better than US disclosure. Why am I going to take on all that cost and infrastructure to meet that? And so that's where this business came from. And it marries itself together when you talk about the type of companies that Richard is talking about on the CSE or that Sarah Louise is talking about on Aquis. Early stage growth companies need a market where they can put their information, they can put their disclosure, they can have a market where investors can access it electronically and efficiently, where price discovery is available, where the rules meet the needs of the investment community and the corporate community without having to run around chasing their tails, trying to stay listed on a US exchange that quite honestly isn't providing them any value. We have companies that are coming off of NASDAQ all the time that say the same thing. It was great to get our picture on the Times Square wall, but I never heard from anybody again. And 700 of those companies are now out of compliance. It's just not the right market for them. I'm not saying it's not the right market. It's just not the right market for those types of companies. And so being able to provide, whether it be US community banks here, of which we have a very large franchise that trade on our QX and QB markets, or international growth and venture companies, a place to be public, to prove their mettle, to focus on their business and growing their investor base, rather than spending an inordinate amount of time focused on how do I stay listed, is really what we spend our time on.
Brian, you sit obviously in a little bit different seat, but obviously critical to this entire ecosystem, advising the types of companies that are here today. So how do you frame up kind of your role within the market and also kind of help companies gain that access to the opportunities that sit here in the US?
Yeah, I would say if you're a small growth company, one of the key things you need is liquidity, because if you don't have liquidity, it's very, very hard then to raise money. Normally, companies with more liquidity find it a lot easier. You also need to get capital at the right cost, going through the right process, and you need to be on the right market as well. And I'd certainly agree that Aquis is a very flexible, cost-effective, efficient market, and the exchange is very approachable. And it is certainly a market that is suited to growth companies that are looking to sort of get onto the first rung of the ladder and then progress up through the tiers of the markets from Access to Apex, but also to use the market as a bit of a stepping stone. And what I like about OTC, and the reason that we're a sponsor on OTC as well, is that UK companies can increase the accessibility of their potential investor base. By being on OTC, you can trade in US dollars during US hours. And obviously you have to be a company that is relevant. You have to be able to sort of be performing well. You have to have a relevant story. But if you can access a wider group of investors, then, without extra cost and hassle, then that's definitely a good step. So with most of the companies we advise, we're always looking to sort of get them onto a market like Aquis and then see what other markets and stepping stones should they be using, depending on their sort of strategy.
Sarah Louise, from your perspective, as we think about kind of advising companies, when is the US market the right step for them? What do they need to think about from an IR strategy standpoint? Sort of how does what you're advising companies kind of dovetail into what Brian was just talking about?
Yeah, and it's really important. It has to be right for the company. If they have a global product or a global outlook, they're opening an office or creating a new subsidiary, then it could be a great opportunity for them to access that US audience from a exposure perspective, from a profile perspective, from a credibility perspective, from a capital raising perspective. Lots of different ways that it can benefit them, and we're really happy that a number of our companies have done that now, and that's right for them. We had Ben talking earlier from Solnox, and they have one business here. They've partnered with someone here that to make their product, and so it makes sense to them. But I think it's also really important. We do spend a lot of time with companies, kind of educating them on the importance of investor relations, to really show commitment to that local market, to show commitment to your investor base and to growing that investor base, you have to talk consistently, and you have to update the market regularly. And so we try and provide as much support on that as possible. We have a capital market support function that helps them. We've been making introductions to a number of organizations and platforms where we've negotiated kind of preferential rates or offers to help them talk to shareholders, deliver those messages at the same time, and just to create more exposure for themselves. So US market is obviously a really important market for many of them, especially lots of companies that are joining recently have a more global outlook, and a lot of them looking to Canada as well. We have a number of companies that have dual listed from Canada too. We offer a sort of fast track in place for those companies, so we try and make it as straightforward again as possible, really focusing on kind of the efficiencies that we can offer.
And Richard, from your perspective, obviously we share a history of kind of Canadian companies accessing the US or international companies using Canada as their kind of listing venue to then access the US. So how are you?
Think of it as the side door to the United States of America. Not the back door, the side door.
I prefer that analogy. Thank you. I prefer that.
Yeah, absolutely. And again, I say this over and over again, and probably most of you have heard me say this before, but one of the enormous benefits of being a reporting issuer in Canada, in fact, you have access to all of the same prospectus exempt capital raising opportunities that you do under US securities law to US accounts. And so that's an enormous bargain when you consider that you don't have to be an SEC reporting issuer and obviate all of the costs that Jason was talking about, but at the same time, you can have the same access to the US capital market, short of a full-on distribution of securities that's cleared by prospectus in the United States. But all of the private placements that you normally do, or the crowdfunding, or the Reg A or the Reg A Plus opportunities are available. The other piece of the puzzle, which again nobody wants to talk about or think about, is the plumbing in back. And that is that the US Clearing and Settlement Organization talks to the Canadian Clearing and Settlement Organization, and the securities are fully fungible between the two. What that means is that you don't have to set up a Canadian depository receipt or an ADR to trade your stock in the US. You're trading the stock. And there's no extra friction, no extra cost. You don't have to deal with the transfer agent on making arrangements to get stock from one market to the other. It just flows cleanly overnight through a link that transfers billions and billions of dollars of securities over the course of the year. So that's an enormous advantage of having that Canadian reporting issuer status that isn't actually accorded to really anybody else in the world. So again, one of the things that we're working on with the companies that are looking to access both the UK market or the European market through the UK market is not quite there yet in terms of that lack of friction in the plumbing. And so I might go so far as to suggest that, in fact, on the UK side, they're not all that interested in reducing the friction, thinking that maybe the market from more companies may be looking to go international. I don't know, could be. But as I say, it's something that we are working on, and there's a lot of smart people that are thinking of the problems and coming up with structures to reduce the cost and to obviously improve company access to the pools of capital.
And Brian, from your perspective, we're obviously talking about a lot about cross-listed companies. What do you think those things are, keys to success for companies as they approach having kind of dual listings across markets?
I would say the ability to trade is obviously key. So you can reduce the friction in some way, shape, or form. That's always the best way of doing it. I would also say that the company has to be relevant to the market as well. So if you just sort of cross-trade on a particular market, if you don't have an investor base within that would be interested in you, you're not communicating effectively, you're not putting out news flow, because again, there's a strong correlation between news flow and liquidity, then no one's going to want to buy your shares. So I think that the first thing is, do people want to buy you? And then the second thing is, can they buy you? And I think tackling those as two sort of separate issues, you really need both in place in order to tick the right boxes.
Those are certainly two elements that we talk a lot about. So,
Yeah.
Jason, is there
I was
anything
gonna
you
add
want to add to the discussion
There's
here?
a third one, and this is the one I find people don't really think about, and certainly CEOs and the corporates don't think about it, is can they buy you, where are they going to buy you, but who's going to buy you? And I talk to a lot of companies that are told, well, I have to go to an exchange or I have to be listed here because that's where institutions, if I'm not listed there, no institution is going to buy me. And then you sit and you talk to the company, and many, obviously, these are early stage growth venture companies. And you look at the cap table of the company and you look at the liquidity of the company and you have a conversation and you say, well, what institution do you think is going to buy you? Oh, well, I have to go see Fidelity and I have to go see Janus and I have to go see Capital. I'm like, nah, you don't have the liquidity, the cap table, the story to be relevant to those institutional investors. And so if you think that going to an exchange is going to get you there, you're probably being sold something by somebody who's going to make a lot of money telling you that being on the exchange is where you need to be. You're not in an index, so you're not going to get those investors either. So the one thing the US has that a lot of other markets don't have is a very vibrant, large, self-directed investor market. And that's why early stage growth companies look to the US. The self-directed investor is probably the largest pool of capital for early stage growth companies in the US than anything else. And if you're in fintech, biotech, resource, mining, green tech, the people you really need to be marketing to and thinking about that are going to help you grow your business and grow your equity story to get you to a place where the institutions are actually looking at you are those investors. And so providing a market where, making sure you've got tradability, so a market where all those investors can buy you, and certainly Aquis and the CSE and OTC are fully electronic markets connected. We're connected to every market maker that trades exchange listed securities as well. So tradability, but then visibility. What are you doing to make sure that those self-directed investors are seeing your story? What are you doing if you're a UK listed company to make sure that your press releases are crossing the ocean? What are you doing to make sure that when you put out your financials that they're being ingested into the US and Edgarized in a format that US investors want to see? What are you doing in Canada to make sure that your security can be bought by somebody with a Schwab account who potentially can't buy direct into Canada in Canadian dollars, needs to buy US dollars in US time zone? All of those things, when we're talking about growth companies, are the things that need to be thought about. And I speak to companies all the time. No, my advisor says I have to go to NASDAQ because no institution is going to buy me. And, all one needs to do is go online and look at all the non-compliant companies that are listed on NASDAQ and New York. And it is a laundry list of early stage growth venture companies that, quite honestly, didn't get the institutional investor and didn't get the liquidity and probably sold their stock to somebody they shouldn't have, and are on this vicious cycle of destruction, value destruction, rather than value growth.
Jason knows that I'm on a board of a NASDAQ listed company that
I
falls
like
into
to-
that category. He's killing me here. He's absolutely killing me. But I joined the board after they made all of those decisions, of course. Yeah, and one of the things I was going to say to companies is it is a real challenge to figure out the right way of engaging with that self-directed investor population. And we have very large self-directed community, obviously, in Canada as well, two largest in the world, side by each. One of the ways of looking at it is there are a number of influential investors in any one of the spaces that Jason. So in the mining world, there's about 4 or 5 really well-known, astute investors who seem to be behind all of the ones that work. That information is available. You can follow them. You can invest alongside those people. So as a company, you may have a few of those people on your cap table. Well, tell that to people. Figure out how to get that word out so that, again, people that are smart enough to say, yeah, I want to invest alongside that guy because that guy has been behind the last 10 mining exploration stories that became producing mines. Or in the technology space, of course, same thing. There are people that have a really good track record of investing in an early stage in public and private companies those are the kinds of folks, as I say, that you do have the opportunity to invest alongside. That really fundamentally is the power of the public markets, because it really does enable everybody to share the fast growth phase of these companies, as opposed to I'll beat the heck out of the private equity guys again, the 1%, the 1% of the 1% who form the majority of the partners behind the private equity funds. I mean, that is very much a concentration of really rich people getting ever richer as a result of the opportunity to invest in the fast growth stage of these.
Well, I'm going to switch gears, but before I do, Sarah Louise or Brian, did you have anything you wanted to add based on the discussion that we were just having?
It's the same experience, really. Yeah, we hear it from companies that say, we went to this investor and this investor and this investor, and they all said no, which kind of like, well, they've never invested in A, your sector, or B, a company of your size. So, know your audience and work with people, advisors that can help you, get to the right people. There are lots of funds out there that invest in early stage businesses, but you're right, they're there in the public. You can find them. So it just takes a bit of work to make sure you get that right.
Go on Reddit and
We're not offering investment advice as part of this panel, for sure, for sure. We are going to shift gears, though, to talk a little bit about regulation, everyone's favorite topic. But each of the markets, so whether we look at the UK or Canada, each of these markets has regulation and a framework that's trying to say, okay, how do we continue to, whether it's keep our companies listed here, as the UK often faces, or just to kind of incentivize growth and investment, retail participation in the market. So I thought maybe I'd give each of you just a little bit of an opportunity to talk about some of the regulations and kind of policy decisions that you think are important to your market as it pertains to venture stage companies and the investors that are here. So maybe Richard, I'll start this one with you.
Well, I mean, this is really an area where, in many respects, we're competing with private equity and other sources of capital for companies. It's fair to say that the regulatory burden that has been placed on public companies generally and early stage companies is something that has gotten to a stage where it has made private equity alternatives more attractive than ever. Now, people need to understand that there are certain types of stories that are perhaps apt or more apt for that kind of finance. But again, we understand that we need to be more competitive in doing that. And our regulators are hearing the message loud and clear. Our own Ontario Securities Commission went on a rampage a couple of years ago, and they, what did they call it? The something reduction, the red tape reduction initiative. To be blunt, we didn't really see anything. I didn't see much red tape reduced, and more importantly, I didn't see any cost reduced. At the same time, we have an economy which is, again, largely early stage companies, and they're talking about implementing mandatory carbon emissions reporting and mandatory other kinds of additional reporting. All of these come from a well-intentioned place, but for God's sakes, a mining company which has maybe 3 full-time employees and contract out their drilling, they contract out their scientific, they contract out all of this stuff, they do not have the wherewithal to meet the requirements that a oil company producing millions of barrels a day from the Alberta oil sands has in order to make these requirements. So again, we are constantly working with the regulators to try to tailor appropriate regulation for the growth stage companies that we can continue to be competitive and again offer the wealth creation opportunities to a broader segment of the public. I guess the one other thing I'll note, Christy, and this is contrast certainly to the United States market. Look at the Magnificent Seven; they're all new companies. They are new companies. If you look at the Canadian market, the top capitalization companies, with one exception, I think Shopify, they're all like 100 years old. That should tell you something.
Mm-hmm. You guys aren't innovative?
Yeah, I think that's actually what it's telling you. And it's kind of funny not to have have some water. But there is, in fact, a big debate Canada right now about the lack of productivity for the Canadian economy versus some of our money. And that's a fair conversation because, exactly to that point, the economy is in fact dominated by a group of not terribly well managed oligopolies who have one key trait, and that is preserving their oligopoly status. And we haven't been able to grow national champions with a couple of minor exceptions. And of course, the irony there is that most of those minor exceptions have been largely funded through US private equity. So again, we do have some challenges ahead of us, and part of the solution is the kind of regulatory reform we talked about to grow more companies to scale, and then again have an opportunity not have them, trade sailed into the Boston, New York private equity world.
On that theme of how do you retain national champions and how do you think about a regulatory structure that allows companies to remain listed locally, what's the conversation, Sarah Louise, from your perspective, kind of as you look at the regulatory environment and sort of what's meaningful to kind of helping companies really remain listed in your markets versus maybe shifting solely to the US?
Yeah, I mean, it's definitely tough. It's been challenging for a while now. I think over the last sort of decade, all the regulation has been sort of skewed towards eliminating risk, and that has resulted in kind of a divestment of investment in small caps. So we kind of need to focus much more on bringing that investment back, on making it not, we're not talking about taking away investor protection, but making it more appropriate for companies to achieve public market status and kind of making it sexy again and all those things. And I think we're kind of starting to see change. There's lots of consultations that's been going on for like the last couple of years on trying how do we make things better? How do we change the regulation to attract more companies and attract more investors? We had a thing called the Mansion House Compact in the UK that's, talking about the pension funds. In 1998, 44% of the pension fund money was invested in, UK small caps. Now it's 4%. So there's a real drive to get that money working again. UK small caps, or small caps generally, bring so much to the local economy, and so it's bringing that back. Also, I think in the UK, I mean, not in the US so much, but we're culturally, we just don't really think about investing. I only found out the other day that my son, who's 21 years old and not working yet, still a student, has a crypto wallet and has been investing in cryptocurrencies with my money because he doesn't earn any money yet. So, like, why? Yeah, I have no idea. Just why is he taking it upon himself to do that and not think about, I'm going to invest in some of the new companies that are coming on to public markets? Probably because it's too difficult and he doesn't know enough about it, even though he's got a mother that works for one. So that's on me, I think, isn't it? So I think, yeah, there's a cultural shift definitely that needs to happen in the UK, and we need government support for that. Regulation wise, it hopefully is coming. Changes are being made to facilitate higher levels and an earlier stage investment, but it's all taking a bit too long. But I think once that comes through, once we get that education going, once we get that kind of cultural shift, hopefully, things will be brighter and it will be better for companies using the public markets to scale. And that's UK, not UK, all the small companies employ people. We all want more jobs and prosperity for all. So it can only be a good thing if we have more companies accessing that.
Mm-hmm. Brian, is there anything you see differently or that you'd add to kind of that discussion on how the regulation can influence some of this?
Yeah, so from a commercial point of view, if you look at a small cap company, it does have the ability to offer outsized returns. But if you look at the small cap fund performance in the UK over the last few years, I think it's been sort of fairly mixed. And I would say valuations in the UK generally for small companies are undervalued. And there have been a lot of companies that have been leaving the UK to sort of come to other markets as well. On a positive note, I think that the new government has made a few announcements that they're looking to make regulation more proportional. They are trying to get the UK to retain its position as a competitive market on a global scale, and that will result, I think, in some changes to regulation being needed to just streamline the ability for investors to invest into small companies, remove some of those barriers and red tape. But these things take time. I think there are sort of movements afoot, and so I would say going forward, it's cautious optimism, I think, and fingers crossed we'll see a decrease in the level of regulation and more, I suppose, supportive regulation for companies.
Jason, is there anything you want to add from the U.S. perspective? We obviously spend a lot of time thinking about regulation here in the U.S. as well.
From a small cap company perspective, I actually think we're kind of right at the start of what is going to be some significant regulatory change for the good, as I think about it, for the good in terms of U.S. investor protection. And I've talked about, I'm picking on NASDAQ, but the small cap exchange listed space, the number of companies that are out of compliance, there's more penny stocks on NASDAQ than on our top two markets. But they're not called penny stocks because you get an exemption if you're on an exchange, but you're trading at 10 cents, 20 cents, and you're allowed to do that for, in many cases, a year and a half, going through all sorts of compliance periods, and you can pay and you can go on an appeal. And so you've got this, take the S&P 500 out of it, you've got some real significant problems in the lower end of the exchange space that the regulations never really thought about or kept up with. So things like what's the penny stock rules, things about, how much money should a company raise in order to be a public company. And I think the New York Stock Exchange wants to put a 10 million floor on that. So if you're only raising 2 million, you shouldn't be a public company. At the same time, you've got some real interesting rules that were never changed as a function of time, and nobody thought about it. So on our market, you can't, securities on our market aren't margin eligible. So I can't margin Roche, Adidas, or Heineken, but I can take a 13-cent NASDAQ stock and margin that because it's on an exchange. And so I think the regulators are starting to see that you take a market like ours, which is a fully regulated super ATS, Reg SCI, SEC, FINRA regulated, with some of the largest companies, both foreign and domestic, that trade here. Community banks, as an example, 200 community banks or whatever that number is. And I think the regulators are now saying, well, if you're going to have markets that are meant for early stage growth companies that meet the need of those companies, then some of the other things need to follow along to make those markets competitive and investable. And whether that's things around ESOP, employee plans for these companies, or margin eligibility, or some of the rules around raising capital, I think we're starting to see that. And that will only make the markets better, for growth companies, but really for the other side of it is the investor protection that goes with that. These are naturally risky companies, as Richard said. But you shouldn't hide that risk through the imprimatur of an exchange listing. You should disclose that risk, and all investors should understand that. And I don't think we're there yet, but I think we're going to start to see that.
Actually, one final thought, too, and I think a great job over the last 20, 25 years in the industry, and part of that is one of the folks that launched the first ETF in the world, but of training the retail investor population that diversification. Now, diversification in large cap probably is good. Diversification in small cap is terrible. And so, again, what people have to understand is get back to the roots, which is the stock picking world. And as I mentioned, it's all about the teams and the backers of those things. And we have to, again, re-educate people that this is the right approach. The point about small cap fund performance was underperformed maybe the broader market indices. Again, no great surprise. But the folks that specialize in that space that are looking at the different metrics that can do spectacularly. Again, no investment advice being offered here.
So I had more. I was going to keep going, but I think what we should probably do at this point, just based on time, is open it up to the audience if anyone has any questions.
Issuers who have come to North America, but particularly the US, I think the OTC's done a fantastic job of basically being known as the go-to guys. In your markets, I think the names that are probably better known are TSXV and AIM. And if you could just explain that there are these other alternatives and how they might compare with those other listing opportunities.
Well, the quick elevator pitch, which I won't, but we have to provide a higher level of service. We're new. They're 153 years old. We have to focus almost to the exclusion of everything else on the issuer. Where the listing ceremony is not the last time we want to engage. Have an ongoing relationship where we assist them telling their story, engaging with the investor population, Canada and the United States and beyond. So you don't necessarily get that level of focus and attention at the other place because they're a big conglomerate. And to be blunt, the analysts are telling, my friend and former colleague John McKenzie, who runs the business, that the trading, that's not good business. Those are variable revenue sources that we can't predict. More information products and more data. That's their focus, right? They are not investing in the listed companies. They are not, either dollars or mind share from the management team. From my perspective and the perspective of the team of the Canadian Securities, exactly the same thing. It's about the company, stupid. I mean, without a solid group of compelling investment opportunities, there's no reason for us to exist. So that is our focus, and that is what we promise to the issuers that decide to work with us.
Add, Sarah?
Ditto. Yeah, same. It's just the whole kind of setup is geared towards the national exchange, and we are not the national exchange. We are a challenger exchange, which means that we can do things better. But it means that it's harder for us to get that message across because everything is set up to funnel one way. And so you kind of have to systematically break those walls and barriers down as far as contacting the tax, department to correct their guidance notes that only mentions the London Stock Exchange, not London Stock Exchanges. So I think challenger exchanges are pretty scrappy. We're quite feisty. We understand that things need to change and we're ready to kind of do battle, but it takes time because things are stacked against us. But as I said earlier, we've attracted more companies over the last couple of years than the incumbent that's been around for 30 plus years, just talking about the growth market, not the main market. And we're doing that because we offer a better service. So we have to just continue that and make sure that there is more funding available and more exposure for the companies.
And I'm just so I appreciate you saying in the US it's us. That was hard for us. I've been doing this for a long time. It is hard. OTC markets, the entire ecosystem in this country, from boutique investment banks to lawyers to accountants, is very much geared to the exchanges. Being able to be at a place where we are now, where we have, 2,500, 3,000 companies on our two main premier boards, a lot of work, a lot of people, a lot of having to go out and fight against the incumbents, because it is stacked. I travel the world. In the UK, it is stacked as the London Stock Exchange. The entrenched interests in keeping that place going are hard. In Canada, the TSX and the TSXV and all the things that they control, it's hard. And it's the same thing here. And the only way we've been able to compete, and I watch it with my partners, is service, good people, and giving people value for money. The second you stop doing that, the other guys are going to win.
Yeah. No, and I was about to, just concluding that thought, I've spent time over the course of my career with the management teams of all the incumbent exchanges around the world. And I will say that New York, when I'm here, I feel like I'm at home.
I was like the Olive Garden. When you're here, you're family.
Exactly. But not a word of a lie. And when I visit my friends and colleagues at Aquis in the UK, as opposed to the church at Paternoster Square, that other place. Aquis and people are yelling and screaming and jumping up and down.
And that's just the CEO.
That's right. I'm home. So again, we have a very comfortable.
The environment in the UK for a US company to cross list into the UK?
So I think if US companies have a product or a service or an office or something that they're launching, then there would be good appetite for it. I think, same with Canadian companies, if they've come over to list to just raise some capital and then go back home and never to be seen again, it doesn't work. But that's the same with any secondary listing. So yeah, there's absolutely appetite for good companies and good management teams and good products from wherever.
Matt, behind you over here.
Hi, what would your advice be to these companies in the microcap and small cap space who are playing the ping pong game of non-compliance periods and need to get a break and are paying six figures for the pleasure of it, but are very scared about the message delisting would send to investors?
Well, I have this conversation about 10 times a day. So I'll tell you what my advice is, because we're getting those calls. The reality is investors can see what's happening. You're not hiding it. The cycle of reverse splits and financings and press releases that you're asking for another 180 days and doing that while you're doing dilutive financings. I mean, watching a company that's out of compliance doing a reverse split and then also doing a placement and a placement with banker warrants included and who the banker, investors see that. You're never recovering from that. In fact, you're probably, if we're having this conversation, the company's gone. I mean, in all honesty. And so you can either own your reputation and you can own your market and you can own your corporate path, or you can be the victim of, again, there's 700 of them, I can print you the list, of going through all of that. And so I tell companies all the time, you are in a much better place to put out the press release that says we are voluntarily delisting. We are going to join QX or QB, or if you don't qualify, Pink. We are going to cut cost out of this nonsense, right? Stop the millions of dollars that we're paying to the bankers and the accountants and the brokers. We are going to focus on building our business back. We are going to focus on our investors. Because remember, all of those companies had real investors at one point that they diluted the hell out of and disenfranchised the hell out of. And if you own that and you raise your hand and say, yeah, we kind of went too fast, flew too close to the sun. We're going to step back. We're going to take a bunch of cost out of this. We're going to focus on our business. We're going to clean up our cap table, because in many cases there's stuff in there that you don't want. And maybe one day we'll be back. And again, there are companies that leave us all the time and go back to the exchange, but they've done it in a way where when they get there, they're much more likely to succeed. And that's my advice. You can say that, oh, I'm afraid the message it sends. If you're at that point, the message is sent. You don't have a real investor base. You've got some stock flippers. You've probably got some bankers that have gotten really cheap stock and they're shorting the hell out. Like you're gone already. I think you're on the board of one of those.
But that's and again, for all the advisors in the room, I mean, I see the story all the time. Good businesses that are saddled with a bad cap table. The question is, up to that and try to repair that cap table in an environment where you're not under constant pressure to do that. We call them consolidations instead of
first splits.
But no, I mean, in fact, in Canada back in the day, when you did a consolidation, it was considered such a negative sign that the exchange made you put consolidated in the name of the company. and a warning to investors that validation in place.
We maybe have time for one more question if there is one, but otherwise I might wrap us up just to keep us on schedule. Anyone have anything else? Okay.
Going once, going twice.
Sold.
Well, thank you very much. Obviously, all of our panelists will be here throughout the day should you guys have any more specific questions. But thanks for being a great audience. We'll continue on the rest of the day.